Good morning, ladies and gents. I hope it's not as cold on your side as it is on my side because it's pretty chilly here. I see it's only 8 degrees Celsius at the moment, and they're also forecasting some light rain. Fortunately, it's not raining at the moment because sometimes it rains so hard that you can hardly hear me. Hopefully, that won't happen today. So today there are a few things that I'd like to discuss with you. First of all, just some minor changes to the work program that is part of your subject guide. So we're going to look at that first of all. So we are not changing any of the topics. It's just that the order in which we are going to be doing the topics will change somewhat. The reason for that is we've got a strange sort of a semester. We've only got 4 weeks of class in the third term, which is quite short, and then we've got 6 weeks in the fourth term. So we had to shift it around a little bit just so that everything fits in nicely. Now, today is going to be more of a discussion or a conversation between you and me. So I am going to invite you later on to speak as well. But first of all, let us just go and have a look at the work program. So I'm just going to display the subject guide for us. If you just give me a second. Perhaps I should just ask first of all, can you hear me? I spoke to a class on when was it, on Monday, financial accounting 2, for about a full minute before I realized I never switched on my microphone. Thank you for the response. You can hear me. Great stuff. So let us just go and have a look at the subject guide. Okay, now you should be able to see the subject guide. Perfect, thank you. So the only amendments, and by the way, ladies and gents, the latest version is on Blackboard. So when you refer to the subject guide, make sure that you refer to that one, the one that states that has the title Financial Accounting 1 Subject Guide 2021, but then in brackets the July update, As we've said last semester, this is almost like a living document, so there might be a few amendments during the course of the year. It'll not be anything major. It's not that we're going to change any topics or anything like that. There are just some things that become known later on during the year, such as, for instance, the assessment dates. We don't know. We haven't got an assessment calendar for the August assessment period yet, so that date will be inserted in the subject guide later on. The same with the November formal test assessments. That is, those assessment weeks, we'll only know the dates later on, and then we'll include them here. Anyway, so the first thing that I'd just like to show you is the assessment dates. So if we just go down, you should know this document quite well by now. There we go, weightings and assessment structure. I still need to go down a little bit. Right, assessment dates and topics. This is the one that we are looking at now. So we've already done the first semester. So the next one is class test number 3. That one there, class test 3. So you can see that we indicate there that it is the week ending the 13th of August 2021. Why are we not indicating a specific day there? What is going to happen, ladies and gentlemen, at the beginning of that week, the 13th of August is the Friday. So on the Monday before that, we will give you like a task. We'll give you some worksheets and some questions, and we'd like you to work through the task during the course of the week. And then at 8 o'clock on that Friday, the 13th of August, an online test will open. So then you will do the online test, and that will be based on the work that you have been doing during the course of the week. So it'll open at 8 o'clock, but it'll be available to you until, if I remember correctly, 5 o'clock on Sunday afternoon, right? So you can write it on Friday, you can write it on Saturday, or you can write it on Sunday, as long as you're done by 5 o'clock on that Sunday, the 15th of August. The actual assessment weeks, the 2 assessment weeks for the August formal assessment start on the following Monday. In other words, 13, 14, the 16th of August, right? So that is the very last week. What are you going to be writing on? You're going to be writing on value-added tax, which we've started with this week. Reconciliations, which we'll do in 3 weeks' time. Reconciliations include creditors reconciliation. We'll talk about that briefly later on. Bank reconciliations, and then also special journals and ledgers. I'll also give you a little introduction into what is meant by special journals and ledgers a little bit later today. Okay, so now if we go to the work program, so there we've got the work program for the first semester. That is now done and dusted. We've covered all of that. Obviously, many of the principles that we've learned during the first semester will be applied during the second semester as well. For instance, when it comes to value-added tax, which we started with this week, you'll also need to know about markups and discounts and profit margins, everything you've learned about last semester already. So, ladies and gents, the order has just been changed a little bit. So this week, those of you who are very eager would have noticed that some of the value-added tax material has already been made available last week, in the last week of the recess. So those who wanted an early start could have had an early start, but if you didn't have an early start, then you'll just have to work hard, like we all will have to do. So this week, the 19th to the 23rd, we're doing value-added tax, which we find in chapter 10, whichever edition you are using. Also, the first part of next week, Monday and Tuesday, you'll still be working on value-added tax. Then from the middle of next week, as well as the week thereafter, we are going to be looking at special journals and ledgers. Ms. Melanie Morris will present those classes for you. You can find that in chapter 11 of either edition. Like I say, the week thereafter, she will carry on with special journals and ledgers. I'll talk about what they are a little bit later. And then in the last week, the fourth week of this term, we are going to look at bank reconciliations and creditors reconciliations. Mr. George Adams will do that with you, and you can find that in chapter 12 of either textbook. But remember, we also give you the page references there, so it's not the whole chapter. In the case of chapter 11 and 12, it is the whole chapter in the case of chapter 10. But those are the page references for that are applicable for what we are going to be discussing. Then we've got the assessment weeks from the 16th to the 27th of August. And then there's obviously a little bit of time for the lecturers to do the marks administration and load your marks. And then the term ends on the 3rd of September. And the final fourth term starts on the 13th of September. And in the fourth term, what we are going to be doing, we are going to be doing property, plant, and equipment. That we'll discuss next semester, so I'm not going to give you too much detail about that today. For probably 2 to 2.5 weeks, and then we are going to do partnerships, probably also 2 to 2.5 weeks. And then we've provided for 2 weeks of revision. The reason for that is really because property, plant, and equipment might be more than 2 weeks. Partnerships might be more than 2 weeks, so that week will probably also be taken up by property, plant, and equipment and partnerships. But then that will be really a revision week. So that week we are going to provide you with a very comprehensive question, or question paper, I should say, that revises everything that we've done during the course of the year, and that will also give you very good preparation for that final November formal test. Right. Okay, ladies and gents, that is the only changes there, just that we've indicated the week that we are going to have the class test 3 in, and then the order in which we are going to be discussing these topics have changed a little bit. So we are going to talk today mostly about value-added tax, but I'm also going to give you some introduction into the other two topics that we are going to be dealing with this term. And then we can talk about property, plant and equipment and partnerships next term. Okay, now I'd just like us to go and have a look at the website, what you can see there already and what you will be seeing there in the future, also how to navigate it. So I'm just going to stop sharing the subject guide, and then I am going to show you the website. Perhaps just before we do that, let me just go to the chat box. Are there any questions from your side at this stage? Then you're welcome to ask it in person, or you can type it in the chat box. I'm actually looking at the chat box now. No questions? Okay, so then let's go and have a look at our website. Let me just go to the home page. I'm just using the site that we're in at the moment, the full-time District 6 site, but remember all the sites are identical. Some of these menu items might be in a slightly different order depending on the site. It's not intentional, it's just the way that it worked out when we designed the site, but everything that's on this site will be on the other site. So there's no difference. So let me go to the home page, which you are familiar with. There you can find the announcements, my tasks, and so forth. Okay, so as you know, our main working area, our working space is that content per topic. You are very familiar with this. Nothing new here. What is new is obviously the topics that we are going to be doing during the course of this semester. So this is where we ended last semester. We did adjustments and closing process, basic financial statements, trading entities, focusing on inventory. Thank you. I saw that many of you kept on attempting that little quiz during the course of the recess as well. And then we ended with that revision tutor class at the end of last semester. So this is now our new topic for this week and next week. You've already probably had a look at that. We are going to go into that folder soon. And then from the middle of next week, this folder will become available with special journals, ledgers, and reconciliations. And those are the two topics as indicated on Blackboard that we'll be doing during the course of this term. And then those two topic 10, property, plant and equipment, fourth term, partnerships, fourth term. And then we've got that revision for formal test 4 that we will do in the very last week of the fourth term before the final assessment weeks start, so that you are very well prepared for the final exams. Right. So ladies and gents, just before we start looking at VAT, value-added tax itself, let's just have a look at what you can find within that folder and what you will be finding soon. So first of all, you know that the learning outcomes are there. You've had a look at that already, at least since Monday. What is VAT and how does it work? That is an empty folder. I've mentioned that in the email last Monday, I think it was. But the recording of this lecture will be loaded there, right? So if you want to have a look again at today's discussion or today's conversation, it will be loaded there. That video, hopefully you've already had a look at, as well as the PowerPoint slides that accompany that. And then we advised you to go and attempt questions 10.1, 10.2, and 10.3. Hopefully you've tried that. You should be able to do that after watching those recordings, and you can find the solutions there. Here we've got a very good lecture by one of our colleagues, Mr. Andile Mjongwana, which you hopefully had a look at as well. And then after today's class, I know you've got stats first, but when you have got a bit of time, I'd like you to go and do question 4, this one, homework questions 10.4, also 10.7, 10.8, right? and then we'll post the solutions for you probably, let's say, by Friday evening. Question 10.5 and 10.6, we've got the solutions there as well as the questions, but you cannot see them on your side yet. What is going to happen? We're going to have our first tutor class for the semester this coming Saturday. I'll send you a link and a reminder about that, probably either late today or early tomorrow. I've got 2 meetings this afternoon regarding the open day as well as a departmental meeting, so it'll definitely not be early this afternoon, but either later today or tomorrow morning. I'll send the link to Saturday's tutor class. And then the one tutor, Miss Sanalisiwe Kalisa, she's going to be doing question 10.5 and 10.6 with you on Saturday, and another question the next Saturday, question 10.15. I'll show you where you can find those questions at the moment if you want to go and preview them already. Right, so those are the ones we'd like you to go and do, and then later on, probably over the weekend, so that you can do this early next week, we're going to give you some alternative perspectives. So there we've got a lecture by our colleague, Dr. Smith, on value-added tax. She's also drawn up this a very short little 9.5-minute video on how the link how there is a link between input and output VAT, which we are going to be talking about today anyhow. Okay. And then we've also got the perspective of Mr. A.B. Adam. Mr. A.B. Adam, which is in London. Who's in London at the moment, but he's provided us with again, an alternative view or an alternative viewpoint on value-added tax, right? So those will also be made available probably Monday next week, so that you can work through that by, let's say, Wednesday when we start the next topic. This one you can already see. This is where we are providing for the tutor classes this coming Saturday as well as the following Saturday. So I'm just going to click on that. So there you'll see on the 24th of July, which is this coming Saturday, we'll load the recording of Saturday's tutor class for you there. But what is already there, let me just click on that. For Saturday, this coming Saturday, question 10.5, we've scanned in. So it's available for you if you want to have a preview, and also obviously on Saturday, when you attend the tutor class, you can have the question handy, as well as question 10.6. What do they require of you? You'll see question 10.5 requires that you to calculate the selling price. Again, this takes us back to inventory selling price, but now we include and exclude VAT, right? So now it brings VAT, value-added tax, into the equation. So there you'll have to calculate output VAT. We'll talk about that soon. Cost price, markup. So everything that you've learned about inventory with regards to trading entities last semester will now be applied here, but we're taking it that little step further because we now also include the value-added tax implications. In question 10.6, goods are sold at a discount on selling price. We will remember we spoke about that last semester, but now we've also got to take VAT into account when it comes to discounts, calculating selling prices, and so forth. And next week, Saturday, the 31st of July, again, Ms. Sanalisiwe Kalisa will do a question with you. This is a very comprehensive question. Question 10.15 from your textbook. Again, the question, we've scanned that in. The question is available there. And that is almost everything but the kitchen sink, right? So it'll take you through the calculations, but you also have to record it now. So it'll require of you to do some journal entries on the perpetual inventory system. So there we again need to know the principles of inventory. You have to prepare a statement of profit or loss. Then you also have to prepare certain VAT-related accounts. Here they mention the VAT input and the VAT output accounts. We'll talk about that a little bit later. And so forth, right, until you end up with a statement of financial position. So very, very comprehensive. Okay, ladies and gents, so before we go into a more in-depth discussion about value-added tax, let's just briefly talk about the other two topics. It's actually, we've combined it into one topic on Blackboard, but really it is actually two separate topics. So let's just talk about them quickly. So let's start with special journals and special ledgers. Excuse me. Now, from the first semester, you are all very familiar with a general ledger and a general journal, right? You all know about that. So we start with our books of initial entry, and you now know that there is something called a general journal. And from the general journal, we post our entries to the general ledger, where all our various ledger accounts are contained in. But, ladies and gentlemen, certain transactions happen on a continuous basis. It happens every minute of the day, whereas certain other kinds of transactions only occur, let's say, maybe once a month. If I can give you some examples here, if you are acquiring inventory, if you are a trading entity and you are acquiring inventory, your purchases will be occurring on a continuous basis. All through the day, you will be buying additional items, additional inventory for selling, right? The same with your sales. Right throughout the day, continuously, you are going to be making sales. You are going to be selling your products, right? So there are hundreds, if not thousands, of those similar transactions every day. On the other hand, something like, for instance, the payment of your, let's say, your telephone account only happens once a month, or the payment of your water and electricity only happens once a month, or the payment of your staff benefits such as salaries and wages, that normally, well, salaries normally only happens once a month. The payment of wages happens once a week. So, ladies and gents, for the purpose of those kinds of transactions that keep on happening all of the time, continuously, such as purchases and sales, we have a separate little journal. In the case of purchases, we'll call it a purchases journal. So that is a special journal. It only relates to our purchases. In the case of sales, we'll have a sales journal, ladies and gents. Again, it's a special journal only relating to sales. Now, why do we do that? The reason for that is, and I think many of you can figure this out already, when it comes to your purchases journal, every time you do a purchase, when you acquire inventory, if you are going to be using the perpetual inventory system, you know that every time you're going to be debiting the exact same account, namely inventory, right? Or if you are using the periodic inventory system, every time that you are doing a purchase, you are going to be debiting exactly the same account, namely purchases, right? So therefore, it would be not very efficient to record that in the general journal every time, because then you have to have two entries, a debit and a credit every time, a debit and a credit every time, and the debit will be the same for each of those transactions, or the credit might be the same for each of those transactions. So therefore, we've got a special journal for something like sales, where we're simply going to look at the total for the day or for the week or even for the month, the total purchases, and then we debit purchases or inventory if we are using the perpetual inventory system only once with the total for that week or that day or that month, depending on the size of the entity, right? If it's a huge company, you'll probably update that every day. The same with sales. Uh, every sale that you make, you will be crediting the sales account, right? So now you have a special journal called your sales journal, where you are going to every day credit. In the case of credit sales, you debit the specific customer, the specific debtor, but you're only going to credit your sales account once a day or once a week or once a month with the total there, right? So that is the idea behind special journals. We've also got some special ledgers. We've got, like the general ledger, but then we've got some additional, sometimes they refer to it as subsidiary ledgers. Two typical subsidiary ledgers would be a debtors ledger and a creditors ledger. Because, ladies and gentlemen, you must, and I'm sure you do realize that when you purchase from your various suppliers, not only must you raise the liability in your general ledger account, your accounts payable account, but you must also keep track who that creditor is, so that at the end of the month you know who you are supposed to pay and how much you should be paying to that specific creditor. And that is also where the reconciliations come in a few weeks' time. Right. The same with your customers or your debtors. Not only when you make a sale should you debit the accounts receivable account, you must also know who those debtors are, right? So therefore, we've got a subsidiary ledger for our debtors, which is almost like the general ledger accounts, except here you detail each specific debtor or creditor in the case of the creditor's ledger by virtue of its name. Right, so if the name of your supplier is ABC Limited, you'll have an account in your creditors ledger called ABC Limited. Right, in your debtors ledger, if your customer's name is Mandla Ganchu, then in your subsidiary debtors ledger, you'll have a specific account for that person, namely Mandla Ganchu. Right, which is, by the way, a good old buddy of mine. So you must excuse me that I've misused his name here. So that is the idea between about special journals, those that are designated for a specific kind of transaction, and then your special ledgers, which are subsidiary to your general ledger accounts. Okay. Anyway, that is just an introduction. Ms. Morris, like I said, will provide you details about that next week, Thursday, right? Uh, as well as the week thereafter. And then in the fourth week, Mr. Adams will be discussing reconciliations with you. But again, let me just give you a brief introduction into reconciliations. Why do we even have something that we call reconciliations? Normally, ladies and gentlemen, it has to do with timing differences. Timing differences. I think I can stop sharing this now. So it has to do with timing differences. Now, what do I mean by timing differences? Let's perhaps just look at a bank reconciliation first. What could happen, ladies and gents, is that let's say one of your customers makes a payment to you as in your business, right? And they send you on the very last day of your financial month, they send you an email with a remittance advice. In other words, their proof of payment, the fact that they have made a payment to you, right? So you record that in your cash receipts journal. Uh, so you record it there, but because that person is at a different bank than you, the money that he pays on that last day will actually only be deposited into your bank account the following day. So if you get a bank statement from your bank, or if you draw it from the internet, you'll see that even though that person indicated that they paid you on the 31st of July, on the 31st of July, that money isn't in your bank account yet. So now you've got to do a reconciliation. Reconciliation, like I say, it's about timing differences. It's really to see why there is a difference in the timing. And then you'll see, right, okay, what happened here is simply the money was paid by that person on the 31st of July, but it only appeared in my bank account on the 1st of August, right? So that then explains why there's a difference. So reconciliation is really to find explanations why there are differences between your records and an external record such as the bank's records. We also have something like creditors reconciliations. Again, that has to do with timing differences, right? So for instance, let's say your supplier, they end their month on the 25th of each month, right? On the 25th of each month, then your supplier sends you a statement, right? But let's say you end creditors, your creditors cycle, your records, you end them off on the last day of the month. That will mean that those transactions between the 25th and the last day of the month will be in their following month's records, but it's still in your this month's records, right? So again, it is just a question of timing differences. So by doing a reconciliation, you'll see why does the balance that appears on their statement not agree with the balance that you have in your, let's say, your creditors ledger. And then you'll see, right, this is the reason because I've purchased from them during those 5 days, the last 5 days of the month, which is not on their statement yet, but it's already in my records. Or I've made a payment to them during that time, which is not on their records yet, but it's already accounted for in my records. So, in a nutshell, a reconciliation is simply to explain or find reasons for why there's a difference between your records and the records of another party, such as a supplier or a debtor. Okay, ladies and gents, now let's go and have a look whether there are any questions, and then you are also welcome to ask any questions about what we've been discussing now so far, um, or you can type it in the chat facility. Uh, uh, Claudia writes this, can you please repeat about the class test? You can actually go and watch the recording, Claudia, but I'll just briefly repeat there. So the class test will be the online test will open on the what did we say, the 13th? Was it yeah, 13th of August? But already on that Monday before that, you will get some worksheets that you can prepare for that class test, and then based on the work that you are going to be doing during the course of that week, you will find the answers to the online test, right? And the online test starts at 8 o'clock on that Friday, and it will be available until 5 o'clock on that Sunday, the 15th. Any other questions, ladies and gents? Any other questions before we start talking about value-added tax? You're welcome, Claudia. Most welcome. Okay, ladies and gents. So, just one question from Apiwe. The final exams cover all the terms or terms 3 and 4? Mr. Vance, I'll get to you just now. Apiwe, the only way that I can really answer that is that the final exams will focus on the work from terms 3 and 4. So that is quite correct. So we are going to be focusing on value-added tax, special journals and ledgers, reconciliations, and then in the last term we're going to look at property, plant and equipment and partnerships. So yes, that is quite true. It'll focus on that. But what you need to realize in addition to that, and this I'm not only talking to Apiwe now, I'm talking to everyone. You must realize that the second semester work is very much based on the first semester work. So you cannot do, for instance, value-added tax. You cannot do some of the second semester work unless you know the first semester work. So when it comes to value-added tax, we've already mentioned that all the principles about inventory will come into play. And then it doesn't really matter which topic we are doing, it's always going to end up in the form of financial statements, because that is what financial accounting is all about. At the end of the day, we've got to report what happened in the company. We've got to report the results of the operations. We've got to report the financial position of the company. We've got to report the cash flows. So at the end of the day, your main mission as an accountant is to report what happened within the company, right? And that is in the form of your financial statements. So again, if this answers your question, you know, you dealt with financial statements in the first semester, but you're always going to be dealing with that. In other words, in the second semester, the same with financial accounting 2 next year, the same with financial accounting 3 the year after. If you're doing the advanced diploma, the same with financial accounting 4 later on, right? So it'll always lead to your financial statements. So that will be relevant forever, if I can put it that way. Also, the principles of closing entries. So, Apuya, thanks, you got it right. So, what I'm saying, yes, uh, the third and fourth term work will be the focus, but you have to know the first semester work to be able to do the second semester work. So, if you are being required to draw up financial statements in the final exams, even though you learned about financial statements in the first term, it's still part of your or the first semester. It's still part of the second semester work as well. Okay. Uh, Mr. Vancy, or difference between sellers and traders. I'm not exactly sure what you're asking there, Mr. Vancy. I guess you are talking about the reconciliations. So that will be differences between, if you are the customer of a supplier, the difference between what the supplier has as a closing balance in their records as opposed to what you have in your records as the customer for the supplier. But normally that will just be a timing difference. If that didn't answer your question, you'll have to re-ask it, Mr. Vancy. Okay, so let us talk about value-added tax. Unless there's anything else, I ask if the bank reconciliation it is to keep track and payments delays. Yes, again, like I said, Mr. Adams will go into detail, but the bank reconciliation is not really to keep track of payments, because that is why you have a cash book, and your cash book has got a debit and a credit side. So again, we have subsidiary ledgers. We've got a cash payments journal and we've got a cash receipts journal, and they combine to give you the details of your bank account. So really, you are keeping track of the transactions in your own cash receipts journal and cash payments journal, or bank account for that matter. So the reconciliation is basically to go and investigate and find the reason why the closing balance on your, let's say, bank account does not agree with the closing balance on the bank statement from the bank. Now, there can be many reasons. Like I said, I don't want to go into too much detail, but normally it'll just be a timing difference. Or there could actually be transactions that you haven't recorded, such as bank costs. Remember, the bank is not going to provide their services for free. They're going to charge you fees, right? And those fees will appear on your bank statement, but you haven't recorded them yet, because you only become aware of those fees once you receive your bank statements, which means in that case you'll have to go and update your bank account, right? So some certain kinds of transactions, you like bank charges or interest received or interest expense on an overdraft, that you'll only find when you actually do the bank reconciliation. Tando, is VAT control a liability? Tando, this not necessarily. I'm going to actually talk about that a little bit later, but maybe now's a good time to talk about it already, since you've already had a look at some of those lectures. It all depends, Tando. To put it very simply, if your VAT control account has a debit balance, and we'll see later on where these balances come from. If your VAT control account has a debit balance, then maybe someone can type for me there. Is it then an asset or is it then a liability? You can type for me there. If your VAT control account has a debit balance. Exactly, Mbuzo, thank you. Then it is an asset. What that comes from, and like I said, we're going to talk about this later again. If it happens that your input tax in a specific VAT period is more than your output tax, and don't worry if you don't know these terms, you should, but we'll get to them a little bit later on. If your input tax for a specific period was more than your output tax, that will result in your VAT control account having a debit balance, which means in that case, like Mbuso said there, then it is an asset. Then the revenue service must refund you VAT. Then you're not going to pay VAT in, and we'll talk about the refunds and the paying in a little bit later. Then they must refund you, so then it's an asset. However, if your VAT control account has a credit balance at the end of a VAT period, we'll also talk about a VAT period later, then it means your output tax was more than your input tax for that period. So the output tax exceeded the input tax. That will then result in your VAT control having a credit balance, and in that case, then it is a liability, right? Which means you'll have to go and pay in some VAT over to the revenue service. Does that answer your question, Tando? Okay, hopefully. Then Mbuso asks, does CPUT do pastel for accountancy? Mbuso, we did pastel until the end of, I think it was the end of last year, or it might have been the end of 2019. This is a long story, if you don't mind. You'll find that you do that in your second year. It's part of a subject called Accounting Information Systems 1B or 1C. I'm not 100% certain now. But anyway, it's accounting. It's one of the AIC subjects, right? Accounting Information AIS. Sorry, AIS. Where am I going? AIS 1B or 1C. But what happened now? Pastel has been replaced by a new package. Pastel is actually PC based, so you load the software on your laptop or on your PC, and then you work on it. But that same company that owns Pastel, it's a company called Sage. Sage has now replaced Pastel by something called Sage One Accounting, which is not PC based, it is cloud based, right? So you don't have to download any software on your PC or on your laptop. You use the software that is in the cloud. So it is web based, if I can say that. So we are now doing Sage One Accounting instead of Pastel. Does that make sense, Mbuso? So it's not our decision. The company that runs Pastel has replaced Pastel. I mean, if you've got an old version of Pastel, you can still use it, but the future is cloud-based accounting, right? So the accounting programs that we are using, that we are teaching in IAS 1 B or C, will be Sage 1 Accounting. Yes, but you are going to be doing that. It is a major part of financial accounting to be able to do it. As you know, even small companies nowadays can afford to run computerized software. So you don't have many businesses who still do it by hand. Very often, when we teach financial accounting 1, but you'll see next year in financial accounting 2 more specifically, we give you the we will say that this is, let's say, your debtor's ledger, right? Your debtor, we spoke about a debtor's ledger. But in the case of let's say, Sage 1, that will be a debtors ledger, but then you refer to it as a master file. It's your debtors master file. But that's just something that you'll learn about next year. Mbuso, does that answer your question? You're welcome to Vancy. Mbuso said asset. Tando is only a liability when you owe, exactly, Tando. It's only a liability when you owe the money to the revenue service. But if they need to refund you, if they owe you, yes, you say you get it, then it's an asset. And Bruce said thank you loud and clear. Okay, perfect, ladies and gents. Any other questions? Okay, I'm just going to disappear off my little face there is just going to disappear for a while. I'm just going to talk a little bit. Uh, the reason I've got one little bad habit that you may know about, so and I don't want everybody to see me doing that. So for 7 or so minutes, you won't see me. What am I doing? What is my bad habit? Who wants to type there? I'm so sorry. I'm a terrible person. I'm providing a terrible example. Yes. Okay. That is quite true. Okay. So, but once, yes, you're all correct. You've all heard that later. So when I'm done with that, then I'll appear again. Forgive me for being a terrible example. Yes, Gustav, yes. Okay, so let us talk about value-added tax. Ladies and gents, I had the privilege to be part of the architect of designing the value-added tax system. My my firm was employed as consultants many years ago, as long ago as 1989, 1990, 91, to do the investigation on how to implement the value-added tax system. Uh, so that is why I said in the email one of the architects will talk about that with you, and that is me. Okay. Um, then what I have to add, there was a system, an indirect tax system in existence at that stage, which was called sales tax, but it was a tax that was very. Mbuso, that is also a good idea, drinking coffee, but I'll do that after the class. Thank you. Um, so there was a system of sales tax in place, but it was very easy to evade and it was very inefficient, which is why it was replaced by value-added tax, which is basically the benchmark internationally for an indirect tax. So, ladies and gents, let's maybe just talk about the basic principles, and then later on I'll open up a whiteboard. We'll take some notes. And then we'll discuss it the particulars. So when it comes to value-added tax, they refer to that as an indirect tax, whereas something like income tax is referred to as a direct tax. Uh, the only reason for that is that in the case of income tax, as you know, a specific person is taxed on his or her income, or an entity is taxed on its income. So it's very direct with regards to who it is taxing. In the case of an indirect tax, such as value-added tax, it doesn't actually tax a specific person. It rather taxes a certain kind of transaction, such as a sales transaction. Now, where does the name value-added tax come from? And this is actually, I only thought about it this morning, that it is quite important to understand. Because if you know what the name value-added tax means, it gives you quite a good clue on already on some of the principles of value-added tax. Now, the tax is really, as the name indicates, on the value that is being added by a business. Let me just pause there. Gillard says, sir, the VAT, it works the same as international countries, or is this just national? No, Gillard, this is now really international. In fact, when I was part of the team of CAs who did the consultation, or who were consulted when we did the investigation on how to implement value-added tax, the systems that we investigated was initially the British system, because they already had a value-added tax system in place, as well as the Australian and the New Zealand system. So those are the ones we've investigated. Then we implemented ours, and most countries in the world who do have a value-added tax system in place were again based on really what we did on our side. Some countries still call it sales tax. For the United States of America, for instance, they still call it sales tax, but it is in actual fact a value-added tax system. So it's not only a tax on the sales, it's a tax on the value that is being added by a specific entity. Masamkele, yes, would you like to ask something? You're welcome, Gilo Mukune.
Sorry, sir. Sorry, sir.
Yes, is it
Go
Masamkele?
on.
Yes,
Yes,
you're
I
welcome to
just wanted
speak.
to ask if to ask if are you sharing? Sorry, are you sharing the screen because I can't see anything over here.
Oh no, I'm not sharing anything at the moment. I'm sorry. I will share a little. I might as well share it now. I'm still going to display my face a little bit in a little while again, if you don't mind. If I'm not too ugly, if it doesn't scare you away from you. Um, then later on, I'll display just a white
No, no,
blank,
no.
a blank whiteboard, and then we can just type in there a
Yeah.
few notes for ourselves. But at the moment, I'm not displaying it.
Oh,
Thank you, thank
okay.
you.
Thank
So,
you, sir. The problem is that I was late because I got a wrong link.
okay, no worries. We are recording this whole session, so you can go and watch it from the beginning later on. I'll only be able to load this later on today, ladies and gents. Like I said, I've got a couple of meetings right after this class, which is going to keep me pretty busy. So I'll probably be loading it after I would say after 5 o'clock today. Ms. Stevensy, so the income taxes are direct taxes. Yes, it's directly on a specific personal entity. Uh, and indirect taxes are based, yes, indirect taxes are, there are quite a number of types of indirect taxes. So value added tax is one of them. So it doesn't tax a specific person, it taxes a specific event, if I can put it that way. Another kind of indirect tax is excise duties. Excise duties. Now, excise duties is a little bit of a hidden tax, but it's there. So excise duties are those additional tax that is being levied on liquor, which we can't buy at the moment. They sometimes call it the sin taxes, right? So those are additional taxes included in tobacco products, for instance, and alcoholic beverages, as another example, right? So excise duties is another example of an indirect tax. So quite correct, Ms. Stevenson. Okay, just to get back to the name value added tax, what it really means is that the value that a specific business adds is what is going to be taxed within that business. Now, to understand that, let's maybe look at a whole transaction. If you acquire merchandise, right? You acquire goods to sell at a profit, then the goods that you acquire already has a value. It already has a value, right? That's why you are paying for it, right? It already has a value. So you now only going to pay tax over, and we'll see later on, the tax is not actually levied on you as a business, it's levied on the consumer, the person who finally uses the goods. But the tax that you raise on it is only the value that is being added within your specific business. Now, how can you add value? For instance, if you are a manufacturing concern, you can purchase raw materials, and then you add some other materials to it. You add labor. In other words, you are converting. Sinitema, I'm not sharing at the moment. I'll share soon again. Um, so you can convert the raw materials by means of applying labor, by means of converting it, and then you obviously get a new product that has now an increased value. Its value has increased. It's worth a lot more than just the original raw materials, because you've converted it by using labor. So the tax on that will then be on the additional value that you have added. Also, if you add a profit, and every business will add a profit, otherwise they'll go out of business, right? That is also part of the value that you have added. So how the value added system works, and perhaps now I should start sharing. Let's just open that blank worksheet. I use Word as my whiteboard. Let me just go and open that. Then at least I'm sharing something. Okay, so there we've just got a blank whiteboard. Okay, so ladies and gents, let me just start there by typing tax on value added, right? So it's called value added tax, but really it is a tax on the value added. So what happens in this case, ladies and gents, when you acquire goods, right? When you acquire goods, your supplier, the supplier of those goods, let's just say you're not a manufacturing concern, you just buy items to sell at a profit. Because in financial accounting 1, we are really focusing on trading companies, as you know from the first semester. So you acquire those items, and your supplier adds value added tax to it, right? So you eventually, when you pay your supplier, part of the amount that you are going to be paying to the supplier will include value added tax, right? But that value is already there. So that means in order for you to only pay over the value, the tax on the value you add, you should be able to use that tax that you've already now paid to your supplier as an input, as a credit, if you can put it that way. So the VAT on acquisitions, and I'm saying acquisitions because this can relate to inventory, but it can also relate to any other kind of acquisition, such as the acquisition of stationery, for instance, or the acquisition of property, plant, and equipment, even on your services, included in services that your suppliers provide to you, your telephone services or your internet services, or water and electricity. It all includes VAT. So your VAT on acquisitions, which is going to be paid, we do that, which is going to be paid to the supplier. We call that input VAT. Input tax or input VAT, right? So that is the value added tax that you've paid to your supplier. The supplier is going to pay that over to the revenue service. Now, this is important to understand. We do not want double taxation, right? The same item mustn't be taxed once and twice and 3 times, 4 times. It must only be taxed once, and that is in the hands of the consumer. But now, once we've paid over that tax to the supplier is going to pay it over to the revenue service, right? So it's already there. They've already received it, the revenue service. So we can't pay that over again. So this input VAT, we must deduct from the VAT that we are going to be raising, right? Does that make sense? Let me just go back to the blackboard to collaborate. I see there are a few items. Yes, it is. Okay. So somebody just asked, I think it was September, whether it's recorded. Yes, it is recorded right from the beginning. Okay. Now, ladies and gents, we add our value. Now, like I say, if it's a manufacturing concern, it is the cost of converting it into a final product. In our case, we are simply a trader where we've purchased finished goods that we are going to resell at a profit. We add the value that we add is basically our profit, right? So now we charge VAT on sales or services that we render. We charge VAT on sales or services that we render. Okay, so that, ladies and gentlemen, that is going to be eventually be paid by our customer to us, right? So paid by the customer that buys it from us, by customer to us, right? Let's put it like that. Because the customer pays the value added tax that we've added over to us, right? We refer to that as the output tax or output VAT, if you wish, right? We refer to that as the output. So on our acquisitions, we've got input VAT, which we pay over to the supplier, and the supplier will pay that over to the revenue service. We now, in turn, we raise value added tax on the sales that we effect with our customers or the services that we render to our customers. They pay it together with the amount that we that belongs to us, that paid over to us. But that tax portion, which we now call output tax, that needs to be paid over to the revenue service, ladies and gents. So how much must we pay over? The input VATs. Let me just go to the chat. The input VATs that you pay over to your suppliers as part of your purchases or as part of paying for your water and electricity and so forth. If you can type for me, ladies and gentlemen, would that be a debit transaction or a credit transaction? In other words, the input VAT. You can debit. Thank you, Tandu. Anyone else? Thank you, Ambrosia. Thank you, Rosha. Yes, that is going to be a debit, ladies and gents. Right, so your input is going to be a debit. So when we are talking about the accounting implications of the value-added tax system, it means when you do a purchase, let's maybe just maybe let's take an example here. Debit, thank you, Lubabalu and Joshua, etc. So let's say you are using the perpetual inventory system, and your supplier charges you 115 rands for that purchase, right? Which accounts are you going to debit? Let's say it's a credit transaction. Obviously, you're going to raise your liability towards the supplier. So you're going to credit that supplier with 115 rands. But that 115 rands includes value added tax at 15%. So with which amount are you going to be debiting your inventory account? You can type for me there. Your inventory account, you're going to debit that with how much? If the total consideration, they talk about consideration, in other words, the total value of the transaction is 115,000. With how much are you going to be debiting inventory if you are using the perpetual inventory system? Somebody take a chance there. Gustavus, yes, okay. If that was 115,000 rand, but I just said 100. Let's just say, let's make it a small little figure. So just 100 rands. So what we are saying, we get an invoice from our supplier. The total consideration that we have to pay to the supplier is 115 rands, right? So how much are we going to debit our inventory account with if we are using the perpetual inventory system, Kaninda? Exactly. Thank you, Glenda. Thank you, Gustavius, Ambrosia, Jeremy, everyone. 100 rands because the additional, thank you, Victoria, Franzel, everyone. Uh, so included in that 115 rands is 15 rands value added tax that we are paying over to the supplier, which the supplier will in turn pay over to the revenue service. Right. Thank you, Mbuso, Lubabalo, everyone. Right. So then, ladies and gentlemen, that 15 rands, because that tax has already been paid to the supplier, excuse me, and the supplier is going to pay it over to the revenue service, it means it has already been paid. So we cannot pay that again. So that means we have to use that as a credit. So we are going to debit an account called our input VAT with, you can type for me there. This is quite obvious, the difference. 15 Rand. Thank you, Ambrosia, Glenda, Sinibuyo, everyone. Oh, you are so quick. Thank you. Okay, so we're going to use that as a, thank you so much, everyone. So we're going to use that as an input tax credit because that has already been paid over to the revenue service. So I'm just going to type there. Thank you so much, everyone. Nati, Masankele, can't mention everyone. Thank you so much. So therefore, we are going to let's just type the consideration for purchase equals 115 rands. Right. By the way, ladies and gents, you can see this little document. I just called it VAT class whiteboard. My autosave is on, so everything is being saved as I type it. I'll also post that to Blackboard. Right. So there we've said accounting wise, it's accounted for. So we're going to let's say inventory. If we are using the perpetual inventory system, inventory with 100 rand, we are going to be debiting that input with 15 rands, 15 rands, and we are going to credit. Somebody's got their microphone on. If you can just switch that off, please. Okay, so that is how we are going to account for it, right? You've already mentioned that yourselves. So that is fairly straightforward. Okay, now let's go and have a look at, let me just see what price is. So in the textbook, they use 14%. In the test exam, should we use price? Remember the value added tax rate was increased from 14% to 15%. I think it was at the beginning of last year, right? If I remember correctly, or was it the year before? I can't remember exactly now. But by the, when the textbook was published, the value added tax rate was still 14%. In fact, I can tell you a story. When we initially implemented value added tax in November 1991, it was implemented at a rate of 10%, and then a few years after that, it was not a few years, about 10 years after that, it was increased to 11 and later on 12%. So it's been creeping creeping up on us, right? Thank you, Glenda. Thank you, Travency. So you say that was in 2020. Okay. So when the textbook was published, the value added tax rate was indeed 14%. And then, like Terency and Glenda says there, then last year it was increased to 15%, right? So in our questions, we will be using the new rate, okay? So in tests and exams, should we use 15%? Yes, yes. So we are using the new tax rate, right? So obviously we're always going to use the rate that is in operation at that point in time. Touch wood, hopefully it doesn't happen, but if they increase the rate to 16%, let's say next year, then we'll be using 16% in the test, right? But that shouldn't change now for a while. They don't change the VAT rate very often. It only happens maybe once a decade or so. Does that answer your question? So yes, the textbook will use 14% because that was at the date of publication, but it has been increased to 15% last year, so we are using the new rate. Okay, now let's go and have a look at the other side of that transaction, ladies and gents. Now let's say we sell the goods. You are most welcome. Now let us say we are selling the goods. Consideration for purchase. Now let's say consideration for sale. Let's say the consideration for the sale is 230 rands, right? The consideration for sale is 230 rands. Now I'm going to ask you a trick question. Right, let's start with a trick question. I love my trick questions. Let's start with a trick question. Kanina, sorry, sir. How does the VAT increase? It is determined by the Department of Finance, the ministry. There's a Minister of Finance. He's got a department which is called the Department of Finance. The Department of Finance actually has got many branches. One of the branches being the Revenue Service. Also the Reserve Bank, also the Fiscal Service. So once a year, the Minister of Finance presents a budget in Parliament. I'm sure you know about that. That happens around about beginning of April. So just like a person, the government must also budget. You know, they cannot spend money if they haven't got the money. Just like you and me, we cannot spend the money if we don't have the money. So the government must, through one of their departments, the Department of Finance, must see what do they budget for expenses. And we know it's not perfect. You know, you couldn't predict that we would have something like COVID-19. You can't predict if you're going to have an earthquake or a flood or some sort of natural disaster. But as far as it is humanly possible, they budget for what their expenses for the next year is going to be, right? And then they also have to budget how are we going to get the money to be able to pay for that, for those expenses. And how does the administration of the country, which we call a government, the people that we entrust to do the administration of our day-to-day lives, how do they get their money that they can build bridges and that they can build schools? How do they get their money? Through what? If you can type for me a three-letter word there, three-letter word. Through what? How does the administration? Through tax. Exactly, Sidwaba. Tax. Thank you, Glenda. That is how the administration of your country gets money. Thank you, Kaninda. So they have various kinds of taxes. We've got income tax, we've got value-added tax, we've got the excise duties, we've got all sorts of we've got capital gains tax. There are many taxes, too many to mention. But that is how they get the money in order to pay for the expenses in order to keep the country running, right? So why did we get there? Oh, the question was who determines that? So obviously the Minister of Finance and all the aides, you know, all the people that are part of that department, they have to now balance the budget. They've got to see that for the expenses that we need for the X amount of expenses, we need X amount of income, right? How are we going to get the income? And then they determine, right, we are a little bit short. We're going to be, let's say, 500 billion rand short. How are we going to get the 500 billion rands in order to cover our expenses? Maybe let's increase the value added tax by 1%. That'll give us enough. Does that answer your question? Is fuel levy a tax? Tulani asked. Yes, that's another one, another little hidden tax, right? The fuel levy, that is another tax that is included in fuel. But on the other hand, fuel is not subject to value added tax again. We'll talk about zero rated supplies and exempt supplies a little bit later. You're welcome, Kanyinda. Essen Kulusweni, you want to ask something?
Yes, I would like to ask something based on your explanation. Is it fair enough for the Minister of Finance and the Cabinet to increase the value added tax from 14 to 15%? Is it fair for the South African citizen?
That is Nkulisweni. That is a Nkulisweni. That is a very good question. Unfortunately, I don't think I should go into the details. What I can tell you is that value-added tax has got a regressive effect. Like I said, I don't want to go in too deeply into it, but what it basically means is that the lower your income, and like I'm treading on thin ice here, but the economists will tell you this: the lower your income, the larger part of your disposable income will be taxed if you have a fixed rate like 15%, right? So to a certain degree, I think it is not the most equitable and just thing on earth to increase the value added tax rate, because it affects the poorer people more than it affects the more wealthy people, if you know what I'm saying. Whereas income tax doesn't have a regressive effect. In the case of income tax, the more you earn, the higher the rate of tax, right? So it would actually be more equitable if you want to look at the justness of it, to rather increase income tax. But like I said, I don't want to go into too much of a debate, but I guess that is what you were going to in any case. It's raising the value added tax rate is probably it's probably the easiest thing to do for an administration. It's probably easier than raising any other kind of tax. But remember also the excise duties, fuel taxes, those have also been raised. Now, I'm not going to ask whether I've answered your question, because I don't think I should go further than that. Let me just go and look at
Okay,
the
so
question. You know what I'm saying, I'm sure.
yes, I know.
A rise in VAT would improve the government's finance. Yes, yes. Look, it's a balancing act to get your budget to balance. Sometimes, I know that the United States administration, they tend to rather not raise taxes but increase their borrowings. Their borrowings from banks, the government, the administration of the United States. I'm not sure how much it is, but it is astronomical. I think we are talking about not billions of dollars, we're talking about trillions of dollars, if I'm not mistaken. But I'm not sure whether that is a sound economic policy in the long term, to keep on borrowing to cover your expenses. Sometimes you've got to bite the bullet, take the pain, and raise taxes. It's one of those things that sometimes needs to be done. Truancy, I think it's not fair because most of SA citizens are struggling to make ends meet. We are actually going to talk about basic food items very soon. Once I'm done with this little example, Truancy and everyone else, I'm going to talk about, amongst other things, basic food. Okay, we'll talk about that soon. Anyway, let's carry on with this little example. I'm going to ask you a trick question, ladies and gentlemen, just as a little test to what you remember from inventory. What is the markup that this business has? What is their markup percentage? Let's see if you can figure that out for me. I know it's a trick question, but I'm sure you're going to get it. Travancy, Lubabalo, nope. Tulani, nope. What is their cost? Okay, type for me in rands. What is their cost? Type for me in rands. What is the cost? Yes, Justin. Okay, there we've got it. Many of you. The cost is 100 rands, right? The cost is 100 rands if you exclude the value-added tax. Remember, the value-added tax is not part of your purchase, right? Because you're going to claim that back. So your purchase price was 100 rands. What is your selling price? Now let's, thank you, Kutso. Yes, that's the purchase price. What is your selling? 200 rands. Thank you, because you've got to add the value added tax of 30 rands. So your selling price is 200 rands. So therefore, if you take 200 rands as a selling price and 100 rands as your purchase price, what is your markup percentage? Thank you, Glenda. There we go. Now you, thank you, Gustavius. There you go. Okay, so now we see that they have a 100% markup. So their cost, you can see we've debited inventory with 100 rands, so that's the cost, and we sold it for 200 rands, excluding the VAT. Yes, Mbusu, exactly. So that is a 100% markup. So how are we going to account for this? Let's go and type that for us. Which account are we going to debit if this is a credit sale? It's going to be our accounts receivable. Accounts receivable. How much must the debtor pay us? How much must the debtor pay us? Let's type that in the chat facility quickly. How much must the debtor pay us? We've got a difference of opinion, but the correct answer there is they must pay us the amount, including the value added tax. So we've invoiced them for 230 rands. They must pay us the full amount. Jemima, how do we get the 100% markup? Jemima, it's the 200 rand selling price. We'll see how when we record it now. It's 200 rand. It's the 200 rand selling price less the 100 rand purchase or purchase price, right? So that gives you 100 rand profit. So 100 rand profit over your purchase price of 100 rand gives you 100%, right? Thank you all. So yes, they must pay us an amount of 230 rands when they eventually pay us. So we're going to bill them for 230 rands. Right, accounts receivable. Then we've got to credit our sales. Just do that credit. Let me just indent that. So now we've got to credit our sales. How much are we going to credit sales with? If you can type for me there, if you haven't already, let me just go there. 200 rands exactly. Thank you all. As we've just discussed, we're going to, yes, thank you. So we're going to credit sales with 200 rands. Then obviously our journal doesn't balance yet. So now we've got to make our journal balance. Which other account do we have to go and credit? You can type for me there. Which other account do we have to go and credit now? We've mentioned it a little bit earlier. Not only that, exactly like
output.
That output. There we go. Excuse me. So now we are going to credit VAT output, right? Remember, we've got 3 VAT accounts, right? So we've got to give them specific names. We've got a VAT input account on our acquisitions. We've got a VAT output account on our sales and services. And then we've got the VAT control account. Okay, so how much are we going to credit this account with? What is the value of the tax that we've raised? 30 rands, right? Just go to the chat quickly. There we go. You've all got it right. Thank you so much. 30 rand. Now, ladies and gentlemen, we see that we've already paid 15 rands in tax over to the supplier. The supplier would have paid that over to the revenue service. So how much should we now pay if the consumer, the person that we've sold it to, is the final consumer? That customer is the person that's going to use the goods. So that person pays us 30 rands, right? So the total tax on this transaction, the total tax on this transaction should be how much? The amount that the revenue service receives in total for this transaction. If you can type that for me, what should be the total tax on this transaction that the revenue service receives? On the total transaction from where it started right till the end. Ooh, we've got a wonderful difference of opinion here. Some say 15 rand, some say 45 rand. And Josh Brown's got it right. So the total tax that the revenue service, remember, ladies and gentlemen, if it's only 15 rand, then it's only on the first part of the transaction, not the complete transaction where it ends up in the hands of the consumer. If the total amount is 45 rands, it means there has been double taxation, which is not allowed. Then we've doubly taxed that transaction. So remember the total amount, like Mr. Josh Brown said there, the total amount that must end up in the coffers, in the bank account of the revenue service once this transaction has been concluded from its origins, from its genesis, right up till its end, must be 30 rands in total. So, ladies and gentlemen, if our supplier we've already paid 15 rands of the tax to our supplier, right? And our supplier has already paid 15 rands over to the revenue service. How much should we as a business, how much should we now pay over to the revenue service? Thank you, Gustavus. It means we must pay over 15 rands. So then in combination, the 15 rands that was paid over by our supplier plus the 15 rands that we are going to be paying over will add up to a total of 30 rands on the complete transaction. We're going to look at the accounting treatment just now, but there's a hand up. Nyakwe,
Thank you. Yes, thank you, sir. Sir, I'm not clear. I want to understand. We have been charged 15 rands VAT input by our supplier, and then we sold the goods and we charged 30 rand of VAT. Now the revenue will get 30 rand of VAT. What happens to the 15 rand? That isn't that we charge 30 rand of VAT, and then the supplier charged us 15 rand of VAT, and then 30 rand. We as the business who are selling the goods, we charge the 30 rand to the consumers. I want to know what happened to that 15 rand.
Okay,
Did you get my question, sir?
Yes, now I get your question. Thank you so much. We're going to actually discuss that now. I'm going to take you the scenic route, the long explanation. Let's maybe start just by looking at the logic, and then we're going to do the accounting transactions, and then we're again going to look at the logic. Let's just think about this. The tax, the value added tax, is levied on the consumer, right? So the only person that actually bears the tax is the final user of the product, the consumer. So the supplier is not taxed, right? They get the tax from us, which is the customer, and then they pay it over to the revenue service. The same with us as a customer. We are not taxed. We are almost acting like an agent to the revenue service by means of collecting the tax from the revenue service, but only the tax from the consumer, and we paid over to the revenue service, right? So we're just acting like an agent. So it's not a cost to us as a customer. It's not a cost to our supplier. It's a cost to the final consumer. And that cost to the final consumer will be what the consumer pays us, which is the 30 rands. Okay, so that is just the logic part. But now we must remember that of that 30 rands that the consumer will have to bear, the tax that that person must carry, 15 rands of that 30 rands has already been paid over by us when we made the purchase to the supplier, and in turn the supplier has paid it over to the revenue service, right? So that money is already in the revenue service bank account. In total, the revenue service must get 30 rands from the pocket of the consumer. So how much must we pay over in addition to the revenue service, in addition to what we've already paid over to the supplier, who has already paid over the 15 rands to the revenue service? How much should we pay over in addition? A further
15 rand.
15 rands, right? And we'll do yes, we'll do the accounting entries now. Now, thank you. I'm glad you understand. You'll understand even better once we've done the accounting entry. But that's good already. That's good already. Now I'm going to ask you, ladies and gentlemen, to figure this out for me. We said right at the beginning when we started talking about value added tax that the name of the tax is value added. What is the value that we have added as a business? Our business, what value have we added? I know this is again a trick question. Like I say, I love my trick questions. So I realize this is a trick question. What is the value that we have? No, what is the value that we have added? Okay, let's start at the beginning. What was the value of the item that we have purchased? Let's say it was just one item. Thank you, Tina Vuyu. The value of the item that we have purchased was what? Thank you, Mr. Sidwaba. The value of the item that we have purchased, thank you, Kazimla. Thank you, Kazimla. The value of the item that we have acquired was 100 rand. Then we sold it for 200 rands, as you can see there, right? We sold it for 200 rands. So what is the value that we've added? What we've added basically is our profit. Like we say, if it's a manufacturing company, it could have been conversion costs and so forth. The only thing that we've added was our profit. So what value did we add? What value did we add? Oh, there we go, Sinuvuyu. Pikulomzi. Bonginkosi, there we go, Lindiwe, Victoria. Okay, so we've added value of 100 rands, right? The value that we've added was 100 rand because we already purchased a value of 200 rands. We sold it for a value of 200 rand. Did I say 100 rands? We've purchased an item with a value of 100 rands. We sell that item for 200 rands. So the value that we have added, as you say, there is then also 100 rands. So if we are talking about a value added tax, the tax at 15% on the value that we've added, that means the amount that we have to pay over is 15% on 100 rand. So we've got to pay over 15 rands, right? Does that make sense? That is where the value added comes from. We're only paying over on the value that we've added because our supplier has already paid over on the value that they have added. Does that make sense? Okay, now let's go and have a look. Thank you, Pikolomzi. Thank you, Myakwe. Thank you, Glenda. Thank you, Kanyinda. Thank you all. Okay, Now, when we do the accounting entries, the closing entries, you'll see that this makes even better sense. Now, ladies and gents, when it comes to the value-added tax, normally we have a 2-month cycle. There are certain exceptions. If the company has got if it's a very large company with sales or revenue in excess of, I think, 5 million, no, not 5, I'm not sure exactly what, then they've got to submit the return every month. But normally, normal businesses have to submit every second month. Okay. So at the end of every second month, they've got to close off their VAT input account and their VAT output account. So, ladies and gents, we'll have to go a little bit quicker now because I see we are slowly running out of time, and I still want to discuss exempt and zero-rated purchase sales. So, ladies and gents, if we are going to close off the VAT input account, that one there, if we're going to close it off, do we have to debit or credit that account? You can just start for me, debit or credit, if we are going to close it off. Thank you, Ambrosia. Thank you, everyone. Now we've got to credit it, right? So we're going to close it off. Thank you, everyone. So let's close it off. So now we are going to say we're going to credit that input by how much? Let's say that was the only transaction. So that's the balance on the account. So we're going to close it off by means of crediting the VAT input by 15 rands. Now, if we are going to close off that one, if we are going to close off the VAT output account, it has a credit balance of 30 rands. So if we want to close it off at the end of the 2-month period, what do we have to do with that account? Debit or credit it? Thank you, Nati, Franzel, everyone. Now we've got to go and debit it. So let's go and do that, ladies and gents. Maybe I'll just type it above that one. Now we are going to debit our VAT output. And if that had been the only transaction for the month, what would the balance on that account be? It would be 30 rands, right? So we are debiting that output with that balance. So that is now a 0. We are crediting that input with that 15 rand. So that account now has a 0. But we have a journal entry that doesn't balance yet. We have to have another credit of 15 rands in order to make it balance. What do we call that account? Those of you who've watched the lecture so far will know, what do we call the account that we are closing it off to? VAT control, Owen, Glenda, everyone, thank you. So that is our VAT control account, right? So now that is our third one, the VAT control account. With how much are we going to credit that account? It's our balancing figure. Fantastic. There are too many to mention. There are dozens of you who's got it right. Right. So, ladies and gentlemen, what we are sitting with now is a situation where that VAT output account has been closed off. It has a 0 balance. The VAT input account has been closed off. It has a 0 balance. Thank you, everyone, again. The only one that now has a balance is the VAT control account, and it has a balance of 15 rands. What does that mean? What does that mean? Once we've done the accounting closing entries here, what does that mean? It means we owe the revenue service money because it's a credit balance. Remember, we said that about an hour and a half ago, right? If it's a credit balance, it's a liability. We owe money to the revenue service. Why do we owe them money? Because of VAT that we have raised on our outputs, on our sales, or on our services rendered. And how much do we owe them, Lubabalu? Yes, everyone, tell me. Asavela, Sanele. What is the balance? 15 rands. Thank you all. So that means we owe them 15 rands. So ladies and gents, like I said, now you'll understand it, I guess, even better. So if we look at the logic of this transaction, what does it mean? It means the consumer, the one that bears the tax, has finally paid over through us and through our suppliers a total amount of 30 rands to the revenue service. That is the total value added tax on the transaction, right? Because they purchase it, the consumer, for a total consideration of 230, which includes the value added tax of 30 rands. So that is the amount that they have borne, right? That is the amount that they are liable for, that has been paid over to the revenue service. But ladies and gentlemen, through this process, through the various steps, what happened is that the first 15 rands of the total 30 rands of value added tax, we paid that to our supplier because the supplier raised it on their sales, right? We paid it over to them, and they in turn paid it over to the revenue service. So the revenue service already has the value added tax on the value of our purchases or our input. Then we've added further value. In this case, the value that we've added is in the form of our profit. We've added further value of 100 rands, right? So that means that we have to pay over an additional 15 rands. So that in total, the transaction has a value added tax of 30 rands. So hopefully this now makes sense. The total amount of value added tax is 30 rands, right? That is the amount that we've raised from the final sale to the final consumer, the person that is going to be using the goods. But in the process, half of that, not necessarily half, in this example it is half, but a portion of that we've paid to our supplier has already been paid over to the revenue service. So we are only making, if you want to call it that, the top up. We are topping it up to the final amount. The final amount that this transaction will bear is 30 rand, but 15 rands of that we've already paid over to the supplier. That is why we've debited input, VAT input. Our supplier has paid it over to the revenue service. So we only have to pay over to the revenue service the difference. So therefore, ladies and gentlemen, the mechanism, and when I designed the value added tax form, the return that must be submitted 30 years ago, that form is still exactly the same as the way I've designed it more than 30 years ago. What you do, you say your total output tax, in other words, what you've raised from your customers is 30 rand, but then you've got a credit. You can deduct all the value added tax that you've already paid to your suppliers, so that in effect you only pay over the difference between what you've raised there in output, what you've raised from your customers or on your customers, and you deduct what you have already paid over or are going to be paying over to your suppliers. Okay, I think that's a good place to pause for just a few minutes, and then I want to address something else before we finish. So let us just see whether there are any questions from your side, or if everything makes sense, you can give me a smiley face or a thumbs up or something. Oh, very innocent. Thank you. Thank you, Dalke. Everything clear. Thank you. Thumbs up. Thank you so much, ladies and gents. So that wonderful. Thank you all. I appreciate that. So that is the basic mechanism. Now, you've already got a lot of lectures available. I'm going to make some more available for you by tomorrow morning. Thank you, everyone. Those lectures by Dr. Smith, our colleague, who also presents Financial Accounting 3 and Financial Accounting 4, or Financial Reporting 4. And then next week, I'll also make available Mr. Adam, the lectures that were prepared by Mr. Adam. There's just one thing that I want us to discuss, and I know that we've only got about 5 or so minutes, 10 minutes. We've got 9 minutes. We've got 9 minutes. We will be able to do that. That's not too bad. That is the matter of registration. First of all, ladies and gents, not all businesses have to register for value-added tax. Not all businesses have to register for value-added tax. If your business has a revenue of R1 million per year or more, right? If your business that you are conducting, if it has a revenue either from sales or from services rendered or whatever way you earn your income, if it's more than R1 million a year, then you must register for value added tax, right? Then it is compulsory. You have to register for value added tax. If your business has a revenue of less than R1 million a year, then it is not compulsory, it is voluntary. So then you can choose, do I want to register for VAT purposes or do I not want to register for VAT purposes? Now that has a few implications. Clearly, most businesses will have a revenue of more than R1 million a year. Most businesses, right? So they have no option. So they have to register. But if it's a very small business with a small revenue per year, then it's not compulsory. But then, ladies and gentlemen, the implications are if you are not registered for VAT purposes, then first of all, Lubabala, that's where I'm going to, Kazimla, I'm going to take your hand just now. Lubabala, I'm going to get to that exactly now. If you're not registered for VAT purposes, then first of all, you're not allowed to raise VAT on your sales. You cannot raise VAT on your sales, right? You're not allowed to. So you cannot add value added tax because you're not registered for VAT. But at the same time, you also do not have the means to claim your input VAT either, right? Because you're not registered, you cannot submit a VAT 201 return, so you cannot claim the input tax back. So if you're not registered for value-added tax purposes, it means your business is in effect the final consumer. I hope that makes sense. If you're not registered for VAT purposes, in effect, it means your business is the final consumer. You will be bearing the value added tax, right? So that means you cannot add value added tax on your sales, but neither can you deduct the value added tax on your purchases. So the value added tax that you pay on your purchases or on your services rendered to you for telephone or internet or water and electricity or printing and stationery, you cannot claim that back. That is the value added tax that's going to end up with the revenue service. Does that make sense? Let me just have a look at Picolonzi. The customer decides to resell the product at value as well. You should have to pay. If you are registered for VAT, Picolonzi, you have to add the value added tax at the end, right? But then you are allowed to claim the input tax back, right? So this is again compulsory. If you are registered for value added tax, you must raise value added tax on your sales. But you are allowed to claim the input tax on your inputs, purchases, and services rendered to you. If you're not registered for value added tax, which is the exception to the rule, so the rule is that you are registered, your business is registered, that's the default. In the exception that you are not registered, then you are not allowed to raise value added tax, but you cannot claim the input back either. Does that make sense? Okay, Picolomzi, you're happy. Kazimla, you got your hand up if you want to ask something.
Good day, sir. I wanted to ask, speaking of business registration, right? What's the difference between a tax number and a tax clearance certificate? Thank you.
A tax number is basically your account number at the revenue service, right? So if you register at the revenue service for income tax purposes, you'll get an income tax number, right? It'll start with a 0, it'll start with a 1 or something like that, right? If you register for at the revenue service for, let's say, employees tax purposes, then you get a different account with the revenue service and they'll give you a different account number for the same business for employees tax purposes, and that number will start with a 7. If you register for value-added tax with a revenue service, you get another account with the revenue service, right? Then you get a different number. So again, you just get a reference number. So that's almost like you, for your debtors, you've got account numbers. They, for their debtors, they've got account numbers. So your tax number is your debtors account number in the revenue services books. And that number, in the case of a value-added tax number, it'll start with an 8. Does that answer your question? Well, not fully yet. So the registration number that you get for either value-added tax or employees tax or income tax, whatever tax you are registering for, that is simply your reference number. So in the books of the revenue service, that is your account number for them. If you've got a debtor called Johnny, and you give that debtor an account number 1234, you've given your debtor an account number, right? So in the same fashion, the revenue service gives you an account number. So that is just your reference number. A clearance certificate is a completely different thing. A clearance, remember, a reference number is just an account number, right? It's the number of your account in their records. A clearance certificate, well, there are many kinds of clearance certificates. It depends on the reason. For instance, if you want to I can't think of an example now. Let's say you want to emigrate, right? If you want to emigrate to let's say Britain, right? Then before you can immigrate, before you can take any money out of the country, you've got to get a tax clearance certificate, which means that the taxman, the revenue service, will give you a certificate that indicates you do not owe them any money. You do not owe them money for value-added tax. You do not owe them money for income tax. You do not owe them money for employees tax or any other kind of tax. So once you've got that clearance certificate from the revenue service that you don't owe them money, then the bank is allowed to transfer your money to Britain. Does that make sense? Okay, ladies and gents, we've only got about 3 minutes.
Thank you, sir.
And next week, Ms. Morris is going to talk about something else. So just quickly, most welcome. Do you understand that now? Okay. Just briefly, ladies and gents, when it comes to value-added tax, we've actually got three types, if you wish. It's not really types, it's ratings. We've got 3 types. We've got a standard rate, standard rated supplies, standard rated supplies. Those are your default again, your normal supplies, right? And the standard rate, as you know, is 15%, right? Oops. 15%. But then you also get something that are called zero rated supplies. Zero rated supplies, right? Clearly the tax rate on that will be 0%. Oops, not supples, supplies. Zero rated supplies. Now somebody, I can't remember exactly who, mentioned a little bit earlier about the fairness or not of value added tax. Now your default on many things, if you buy clothes or if you buy cool drink or if you buy whatever, most things, it'll be a standard rated supply. So the value added tax rate is 15%. But certain items are zero rated, ladies and gents. And one person mentioned that in the chat. Now, I haven't been following the chat for the last while because I've been talking and typing and what have you. But I remember somebody mentioned something about basic foodstuffs, right? So your zero-rated supplies are actually the basic foodstuff. There are some other categories. Was it you, Trevency? Thank you. Trevency? Thank you. Now I remember. So basic foodstuffs such as brown bread is zero-rated. Milk is zero rated. Maize meal is zero rated. So those basic foodstuffs are zero rated, which means, ladies and gentlemen, that the consumer beans as well. There we go. That means, ladies and gentlemen, there is no value added tax on those items. How does it work? It means the supplier, if you go and buy it at Pick n Pay or Checkers or ShopRite, it means they do not add some agricultural products, Loyola, correct. It means they do not add the value added tax at the end, but they can still claim the input tax back. So if they had paid 15% input tax on it, they can claim it back, but they add zero at the end to the consumer, which means that at the end, there is no value tax on it. Why are they zero rated, Lugabalu? That is something you have to ask the administration and the Department of Finance. That has to do with fairness. That really has to do with fairness. You don't want your basic foodstuff to carry value-added tax. Things like brown bread. White bread does, because it's almost like a luxury item, right? White bread does carry VAT, but not brown bread. Maize meal, many other items of basic foodstuff do not carry value added tax, right? So that is referred to as zero rated. I hope that answers an old question from earlier today about the fairness. So even though value added tax might not be perfectly fair, at least there is some attempt, there is some relief when it comes to basic foodstuffs. The same applies to exports. If you export something to a foreign country, it is also zero rated because we cannot charge citizens of other countries for value-added tax. Then there's one-third supply, ladies and gentlemen. I know you've got to go to your next class soon. Let me just do that. That's my last point for today. That is exempt supplies. Exempt supplies, ladies and gents. What does exempt supplies mean? It is very similar to a zero-rated supply. In other words, no value-added tax is added to it. No value-added tax is added. But the difference between a zero-rated supply and an exempt supply is a zero-rated supply, the company is allowed to claim the input tax back. But in the case of exempt supplies, they cannot add input tax, but they also cannot claim back the input tax. Under import service, no, import service is not exempt. If you import something, value added tax has to be added to it, right? So you have to pay value added tax over on any imports, just like a normal purchase. Now, ladies and gents, sorry, last point, just one more minute. An exempt supply, what would typically be exempt supply? Residential housing. Residential housing is a very good example of an exempt supply. So if there's let's say a person that rents out all sorts of property, an estate agent, right? An estate agent that rents out properties. When they rent out properties to businesses, then it is standard rated. So they have to charge value added tax on it. If they rent out properties to private citizens like you and me for residential purposes, it's an exempt supply. They cannot add value added tax. So there's no value added tax on residential properties, but in the case of exempt supplies, they also cannot claim the input tax back. Furniture, shoes, clothes. No, furniture, shoes, clothes are all standard rated, unfortunately, right? Furniture, shoes, they are all standard rated. Ladies and gents, thank you so much. It's 1 o'clock. I know you have to go to your next class. You are most welcome. Tavansi, everyone, you are most welcome. I'm just going to stay here for 2 minutes or 3 minutes if there are any further questions that you want to ask. But remember, you can always email me as well, right? And I will be present on Saturdays in Saturday's tutor classes. You're most welcome, ladies and gents. Have a lovely next class. Have a lovely afternoon. All of the best for the semester. I know you will enjoy it and you will do well. Go well,
Thank you,
Moinhoop,
sir.
Hamba Kahle.